The stock market hit an all-time high today. Somewhere, a chyron, that scrolling banner at the bottom of a news broadcast, just said that. A ticker scrolled. A financial anchor straightened their jacket and delivered the number with the quiet satisfaction of someone who believes they are reporting good news. And they are, for someone. But here is the thing. Somewhere else, probably quite close to wherever you are, someone is choosing between their rent and their grocery bill. Or paying the minimum on a credit card that has been quietly compounding against them for 3 years. Or watching their employer announce a strategic restructuring to drive long-term shareholder value, which is a sentence that means their job no longer exists. Both of those things, the all-time high and the person doing the math on their kitchen table, are true at the same time. Every day. Often on the same day. The question is not which one is real. They are both real. The question is why we built a system that treats one of them as the headline and the other as a footnote, or more often as no note at all. The stock market is not a thermometer for the economy. It never really was. But somewhere along the way we collectively agreed to treat it like one, to let a single number that represents the equity valuations of 500 large companies stand in for the economic experience of 330 million people. That is a substitution so massive and so consequential that it deserves its own episode. So here it is. The numbers and the mechanics. Let's start with what the S&P 500 actually is, because this is where the confusion begins. The S&P 500 is an index, a basket of 500 companies, selected by a committee at S&P Global, weighted by market capitalization. When people say the market is up, they usually mean this number went up. It is the most widely cited benchmark of American equity market performance, the thing financial television treats as the pulse of the economy, the number presidents point to when they want to claim credit and quietly ignore when they don't. Here is what it is not: a representative sample of the American economy. The U.S. economy employs approximately 160 million people. Footnote 1. The S&P 500 tracks 500 companies, and not even 500 equally. It is market cap weighted, which means the biggest companies pull the index the hardest. As of mid-2026, the top 10 stocks in the index account for approximately 35.8% of its total weight. Footnote 2. The top 5, Nvidia, Apple, Microsoft, Amazon, and Alphabet, account for roughly a quarter of the entire index. Footnote 3. So when Nvidia has a good quarter, the index goes up and the chyron reads markets rally, and this is technically true in the same way it is technically true that a football team scored when only one player actually kicked the ball. That concentration is not a historical constant. It is a recent and accelerating phenomenon. In 1990, the top 10 S&P 500 companies accounted for about 19% of the index's total weight. By 2015, still roughly 19%. By the end of 2025, that number had nearly doubled, reaching just over 40%. Footnote 4. The index has, in the language of the analysts who track this, undergone a great narrowing. It increasingly reflects the fortunes of a small cluster of technology and AI-adjacent megacaps, while 500 companies' worth of diversification becomes somewhat nominal. RBC Wealth Management, tracking this data through FactSet, put the issue precisely. By the end of 2025, the top 10 stocks represented about 41% of the index's total weight but were generating only about 32% of its earnings. Also footnote 4. That gap, 9 percentage points between what these companies are worth on paper and what they actually produce in profits, is itself a signal worth sitting with. Market value concentration has run significantly ahead of fundamental profitability. That is not a small discrepancy. That is the index pricing a story about the future, not just measuring the present. Now, here is the number that should stop you. 62% of Americans own stock. Footnote 5. That sounds like a broad base. The chyrons like that number. But owning stock and being meaningfully affected by stock market performance are very different things. Most Americans who own stock own it through a 401k or retirement account. It is a long-horizon asset, not a source of daily economic experience. And the distribution of that ownership is so extreme that the phrase stock market performance has almost no practical meaning for most of the population. As of the fourth quarter of 2025, according to Federal Reserve data, the wealthiest 1% of Americans own approximately 50% of all equities. The top 10% own 87%. The bottom 50% of Americans by net worth own roughly 1% of all stocks, worth about $620 billion in an equity market valued at tens of trillions. Footnote 6. So when the market hits an all-time high, the direct financial benefit of that event flows overwhelmingly to a narrow slice of the population. The other 90% experience it largely as a number on a screen. This is not a neutral observation. It is the foundation of everything that follows. The global comparative layer. The United States is not the only country where this gap exists, but it is where it is most pronounced and most consequential, because no other country's equity market carries the same weight in the global financial narrative. The Buffett indicator, a rough ratio of total stock market capitalization to GDP, named after Warren Buffett, who once called it probably the best single measure of where valuations stand at any given moment, sits, as of 2026, at historically elevated levels in the U.S. By some measures above 190%. Footnote 7. For context, a reading of 100% suggests the market and the underlying economy are roughly sized to each other. A reading of 190% means the stock market is nearly twice the size of the economy it nominally represents. The two things are not measuring the same thing. They have not been for some time. Look at what happened in 2020. The COVID-19 pandemic hits. The U.S. economy contracts by 2.8% in real terms, the sharpest annual decline since World War II. Footnote 8. More than 22 million Americans lose their jobs in March and April alone. Footnote 9. And the S&P 500, after a sharp initial drop in March, ends the year up 18.4%. Footnote 10. Read that again. The worst economic contraction in 80 years. An unemployment shock of a scale not seen since the Great Depression. And the stock market finishes the year up almost a fifth. The correlation between what the market was measuring and what was happening in the economy was not just weak, it was briefly negative. The market went up because the economy collapsed, or more precisely because the Federal Reserve and the Treasury Department deployed trillions of dollars of stimulus in response to the collapse, much of which found its way into financial assets rather than into the pockets of the 22 million people who had just lost their jobs. J.P. Morgan's research on this divergence is instructive. Looking at performance since 2000, S&P 500 earnings per share are up roughly 356%, and the total return of the index is up approximately 632%. Nominal GDP over the same period has grown about 200%. The average company, measured by an equally weighted index of around 1,700 firms, the Value Line Geometric Index, which is a much closer proxy to the actual economy, is up just 47% over the same period. Footnote 11. 47% in 25 years. Against 632% for the S&P 500. Same country, same currency, same nominal economy. Completely different outcomes. The reason is not mysterious. The S&P 500 is not tracking the average company. It is tracking the biggest companies which have benefited from a specific set of structural advantages, network effects, global reach, low marginal cost of digital expansion, and a decade and a half of near-zero interest rates that made borrowing cheap and inflated the value of future earnings in today's prices. The rest of the economy, the manufacturers, the regional banks, the mid-sized service companies, the businesses that employ most of the people, showed up in the other index. The one nobody puts on the chyron. Other countries tell a version of this story with different details. Japan famously saw its Nikkei 225 hit its 1989 peak and then spend 34 years below that level, a generation of stock market stagnation coinciding with, and partially caused by, a real economy that continued functioning, if slowly. Footnote 12. China's Shanghai Composite has for years tracked its own story, one that has very little to do with the extraordinary pace of Chinese economic growth. As the CFA Institute noted in research on the question, the correlation between GDP growth and stock market performance in emerging markets tends to be lower, and sometimes negative, precisely because the stock market represents a narrow slice of listed companies, not the economy as a whole. Footnote 13. The market is a scoreboard. It just turns out to be a scoreboard for a specific game, played by a specific set of players, with rules that most people were never told about. So here is the Captain Obvious question: why isn't IT being fixed? So if the S&P 500 is a poor proxy for the health of the broader economy, why do we keep using it as one? The short answer is, Because it is useful for the people whose job it is to explain the economy in 30 seconds or less, and because the people it genuinely represents have substantial influence over how it gets discussed. Option 1. Use a better index. This is technically available. There are broader indices. There are equal-weighted versions of the S&P 500 that treat each of the 500 companies as equivalent regardless of size. There are indices that include smaller companies, more sectors, more of the actual economic landscape. None of them get the chyron treatment. The market cap-weighted S&P 500 became the default benchmark, and it will remain the default benchmark because it is the benchmark that financial products are priced against, that fund managers are measured against, and that a very large industry has spent 40 years building infrastructure around. Switching the headline indicator would be technically simple and institutionally impossible. Every door has a locked room behind it. Option 2. Stop treating the market as an economic indicator in public discourse. Also technically possible. Also unlikely. Financial media's entire architecture is built around the daily movement of equity prices. The market goes up, the market goes down, and this structure generates continuous content, continuous advertising, and continuous reassurance for the 62% of Americans who own some stock and would like to believe their retirement account is doing fine. The gap between that belief and the reality of who owns how much is never quite the headline. Option 3. Acknowledge the divergence and report accordingly. Quote the market number alongside unemployment, wage growth, consumer debt levels, and housing affordability as part of a fuller picture. This happens occasionally, in the better corners of financial journalism, on the days when the divergence is impossible to ignore. It does not happen systematically. The chyron is one number. It is always the same number. The structural reason behind all of this is simple. The stock market, as currently constructed and discussed, measures the returns to capital. GDP, wages, employment, and housing affordability measure the returns to labor and to people who do not own significant capital. These are genuinely different things. They can move in the same direction, and they often have, historically. They can also move in opposite directions, and when they do, the capital return metric gets the headline because the capital return metric is what the institutions that fund financial media care most about. This is not a grand conspiracy. Nobody sat in a room and decided to deceive the public. It is a set of incentives that produces a consistent result. The market gets reported. The divergence gets a footnote if it gets anything at all. The geopolitical undertow. There is one more layer here that rarely gets examined in the domestic conversation about market performance, and it matters more than it used to. The S&P 500 is not just an American story. The companies in it are global. Apple manufactures in Asia. Alphabet earns revenue from every country with internet access. Nvidia sells chips wherever it is allowed to sell chips. When the index goes up, it reflects, in part, the extraction of value from labor markets and consumer bases around the world, value that flows back into equity prices, and therefore back to the top 10% of American households who hold 87% of American stocks. This matters geopolitically because the rest of the world is watching. The dollar is the world's reserve currency, which means U.S. financial assets, treasuries, equities, dollar-denominated debt, occupy a structurally privileged position in global portfolios. As we explored in the Economic Reckoning series, this privilege is increasingly contested. China's steady divestment from U.S. treasuries, the BRICS drive toward alternative reserve arrangements, the Gulf sovereign wealth funds increasingly deploying capital into non-dollar assets. These are partly economic decisions and partly strategic ones. And one of the things driving them is a growing recognition that the American economy and the American stock market are increasingly separate objects, with the stock market functioning as a redistribution mechanism that benefits a specific domestic constituency and extracts value from a global one. There is also a domestic political dimension that cannot be fully separated from the economic one. In an environment of elevated inflation, rising debt costs, and labor market uncertainty, the environment we have been mapping across this series, the optics of an equity market at or near all-time highs while household financial stress remains elevated create a specific kind of political pressure. It is the pressure of a system that appears to be working and is not working for you. That perception gap has electoral consequences, institutional consequences, and eventually, if history is any guide, market consequences too. Warren Buffett's observation about the Buffett indicator was made in 2001. He noted that when the ratio of market capitalization to GDP runs significantly above 100%, you are playing with fire. Footnote 7. As of 2026, the ratio is approximately double that threshold. Nobody is quite sure what that means or when it matters or how the adjustment happens when it does. What everyone who looks at this seriously agrees on is that a market nearly twice the size of the economy it nominates itself to represent is measuring something other than the health of that economy. What it is measuring, who benefits, who designed it to benefit them, and how that design got built into the machinery of corporate governance, that is the subject of the next 2 episodes. Because the market is not broken. It is working exactly as designed. We just need to read the design documents. To put this into some kind of perspective that may make sense, the S&P 500 is a number. It is a real number tracking real assets, representing real wealth, for someone. The question this series is asking is not whether the market is legitimate. It is whether the market is what we say it is when we put it on the bottom of the news broadcast ticker and call it the economy. It isn't. The gap between the two is large, it is growing, and it is not an accident. Next episode, a company announces mass layoffs. The next morning its stock price goes up. We are going to talk about why that is not a glitch in the system. It is the system functioning perfectly. For its intended beneficiaries.